Hello, welcome to the fifth module of the course Economic Management and Policy Analysis. And we'll be discussing about monetary policy and financial sector management. Monetary policy and financial sector management. And in doing this, we will quickly look at some key concepts. Briefly, we'll look at some key concepts and we will look at central bank role and functions. We'll look at the money supply and interest rates. We also look at the inflation targeting versus exchange rates targeting. We'll look into the banking sector regulation and also we will look finally into the financial inclusion and development. Monetary policy involves deliberate action by a country's central bank to regulate money and credit supply, aiming for price stability, economic growth, and financial stability. And it uses instruments like interest rate, reserve requirement, and open market operation to influence borrowing, investment, and consumption. And the financial sector, encompassing the bank, non-bank financial institution, and capital markets, mobilizes saving, grants, credits, and facilitates investment. Also, the financial sector management involves regulating, supervising, and developing these institutions to ensure stability, efficiency, and inclusiveness. At the heart of monetary policy is the central bank, money supply, and interest rates. Briefly, central bank is an independent authority issuing currency and controlling inflation, managing exchange rates, and acting as a lender of last resort. As per total money supply, this is total amount of money circulating in an economy. And for the interest rate, it is the cost of borrowing or return on savings. Now let's elaborate on the central bank role and function, which we can term as the guardian of economic health. And the central bank is the apex monetary authority, ensuring financial stability and guiding sustainable economic growth. Unlike commercial banks, it regulates the financial system and custodies monetary policy, extending its function to currency stability, public debt management, and acting as a leader of last resort. And in terms of its function, and see that it performs a function of currency issuance and control. And by this, we talk about exclusive rights to issue legal tender, ensuring uniformity, credibility, and security of the monetary system, and carefully manage to avoid inflation or scarcity. Also, we look at the role or function of monetary policy formulation. And by this, we talk about the design and execution of policy for price stability, inflation control, growth stimulation, and full employment via interest rates, reserve requirements, and open market operations. Another is the price stability maintenance role or function. And for this, central bank controls inflationary pressures and prevents deflation, preserving purchasing power, promoting investors' confidence, and supporting the long-term planning. Also, they perform a role or function of regulation and supervision, and as such, they regulate commercial banks, setting prudential guidelines, monitoring compliance, and also enforcing standards to maintain financial discipline and protect depositors. They also provide a role and function of foreign exchange management. And at this, they manage foreign exchange reserve and exchange rate policy. And by this, they intervene in currency markets to stabilize rates and maintain international competitiveness. Another is that they serve as lender of the last resort. And for this, they provide emergency funding to financial institutions during crisis or liquidity shortage. And they also prevent systemic collapse and safeguarding stability. And finally, we look at them having the role or function of debt and fiscal support. By this, they collaborate with the government on public debt management, including issuing securities and financing deficits without jeopardizing price stability. Moving to the money supply and interest rates. And when we talk about this, the relationship between money supply and interest rate is fundamental to monetary policy, and it influences economic activities, investment consumption, and overall financial stability. And with this, we need to understand what money supply means. And this represents the total stock of financial assets held for transaction, total stock of financial assets which are held for transaction, precautionary or speculative purpose. So this can be categorized into transactionary motive of holding holding money, precautionary motive of holding money, and the specific speculative motive of holding money. And it can be categorized into M1, which is the currency in circulation and demand deposits, and it is most liquid. And also we have the M2 and M3, which is broader definition, including saving accounts and time deposits. And it's influenced by the central bank through open market operation, reserve requirements, and policy interest rates. Now moving to the interest rate, having an understanding into interest rate, you see that the price, this is the price of money determined by demand and supply in the financial market. And they are a reward for saver and a cost to borrower. And interest rate can also be classified into two, which is nominal interest rate and real interest rate. For nominal interest rate, it's stated rate without inflation adjustment. It is stated rate without inflation adjustment. And for the real interest rate, it's true borrowing cost after inflation adjustment. And central bank influences interest rate via their monetary policy rate, which is MPR, to achieve macroeconomic stability. What then is the interaction and implication when we talk about money supply and interest rate? Now, the interaction between money supply and interest rate is crucial, and we can see the expansionary policy and the contractionary policy. For the expansionary policy, this shows that increase it leads to increased money supply, then to lower interest rates, making borrowing cheaper and encouraging investment and consumption. And for the contractionary policy, this results in a reduced money supply, often raises interest rates, making borrowing costlier, but controlling inflationary pressure. And for economic implication of money supply and interest rates, we can say that it's excessive money supply can fuel inflation, and higher interest rate can reduce it. So you can see it in the place of inflation control, and also in the place of investment and growth. Lower interest rates stimulate productive investment, supporting economic expansion. And for under exchange rate, higher rates attract foreign investment or investor, and strengthening currency, and also lower rates weakens it. And for financial stability, we see it in the aspect of balance between liquidity and stable interest rates prevent credit bubbles or stagnation. Moving to understanding inflation targeting versus exchange rate targeting. These two major strategies, they are for macroeconomic stability, differing in focus, implementation, and implication. So there are two strategies for macroeconomic stability, and they define aspect of focus in terms of implementation and implication. Inflation targeting. Central bank commits to maintaining inflation within a specific range, for example, 2 to 3%, and the primary goal is to ensure price stability. And also, in terms of transparency, the publicly announced targets and clear communication. And in terms of flexibility, they allow response to shock. An advantage of inflation targeting is that it promotes long-term price stability, it enhances central bank credibility, and also reduces uncertainty. However, it has its own limitation, and these include it may ignore other objectives. Also, it's vulnerable to external shock, and also requires strong institutional capacity. For exchange rate targeting, it talks about central bank aim to stabilize domestic currency against another or a basket of currency. And looking at this, it plays a major role in stability, that is, provides confidence to investors and traders, and also as external balances, which means that it prioritizes stable trade relation and prevents current crisis. And as per intervention, it uses foreign reserve to maintain target. An advantage of exchange rate targeting is or her the advantage are that it encourages international trade. It also acts as a nominal anchor and effective for small open economy. The limitation of exchange rate targeting, that it results in loss of monetary policy independence, a vulnerability to speculative attack, and it actually requires large foreign exchange reserve. We move to the banking sector regulation. Banking sector regulation. And when we talk about the banking sector regulation, there are rules and framework imposed by authorities to govern banks, ensuring financial stability, protecting deposits, and promoting economic growth. And the key banking regulations include the capital adequacy. And for this, we talk about banks must maintain minimum capital relative to risk-weighted assets. Example, the Basel Accord, to absorb losses. And another regulation is the liquidity requirement. And for these, banks must hold liquid assets to meet short-term obligation and prevent insolvency from withdrawals. Also, another regulation for banking sector is the prudential regulation. And for this, it covers lending practices, where loan classification and provisioning for non-performing loan to prevent reckless lending. And also, another is the consumer protection. For consumer protection, it's a rule that protects consumer from unfair practices, ensuring transparency in financial products. We also have the AML and the CTF regulation. For this, bank monitors and reports suspicious activities to prevent illegal use of institution, complying with international standards. And lastly, the supervision and reporting aspect of regulation. And this talks about banks submit regular reports. Regulators conduct inspection and stress tests to ensure soundness as per the banking activities. And lastly, we look at the financial inclusion and development, financial inclusion and development. And when we look at this, this is the, it ensures individuals and businesses, especially on the served group, have access to affordable and useful financial products and services. This fosters economic participation, equity, and sustainable growth. And as such, the importance of financial inclusion and development are that it empowers also to save, manage risk, and invest. Also, it promotes social equity by bridging the gap between the rich and the poor. Also, it strengthens government policy by enabling direct transfer. And the challenges of these include inadequate financial literacy, poor infrastructure, especially in rural areas, high cost of providing services to low-income population, and lastly, the regulatory barriers and gender disparity. We have the channel to development there. We have the policy intervention also. And in conclusion, monetary policy and financial sector management are indispensable for economic stability and growth. Central banks maintain price stability and investment confidence by regulating money supply, interest rates, and credit. So banking regulations ensure resilience and transparency, while strategy like inflation targeting and exchange rate targeting management balances domestic stability and external competitiveness. Financial inclusion on its own expand access to services, empowering marginalized group and promoting equitable development. So an effective synergy among these elements provides a solid foundation for sustainable economic progress and resilience against global financial shock. Thank you.